So how are companies managing their digital assets in this fast-moving space, constantly changing space? A few years ago, the answer was pretty simple. They just buy and hold some Bitcoin and they hope for the best. But we're seeing this fascinating shift away from simple buy and hold tactics and moving towards some really sophisticated strategies. Today, Treasuries, which are basically reserves that companies hold, are way more sophisticated, right? They're not just letting their crypto sit there. They're actively putting it to work to generate rewards. And that's exactly what we're going to unpack today. We'll explore how these approaches have evolved and then talk about wBLT, which is, if you don't know already, it's a type of asset that's built by BMX specifically for sustainability and long-term growth. Welcome to Unwrapped. This is a series in the BMX Crypto podcast where we explored DeFi, NFTs, on-chain culture, and all things in the BMX ecosystem. And just a quick but really important note before we dive in, this content is purely educational only. It is not financial advice. Think of it as more of a conversation about where crypto treasuries were and are headed. Always do your own research. So start with the basics. What do I mean when I say crypto treasuries? Traditionally a company's treasury is basically its rainy day fund. Like think cash in the bank or government bonds. It's all about being safe, being steady, being focused on preserving capital, right? Not taking risks. Crypto treasuries, though, they flip that whole idea on its head. Instead of just holding cash, companies are strategically holding digital assets like Bitcoin and Ethereum. And they're willing to take on some volatility in exchange for long-term growth. And this is the key part for active reward generation through different mechanisms available through different designs in the blockchain space. And a perfect example of the early days is MicroStrategy. They famously went in on Bitcoin as their primary treasury asset, and that was sort of the first wave. But we'll see how the space has evolved quite a bit since then. So let's talk about how these strategies have evolved, because things have changed pretty quickly. If you rewind just a few years to 2020 or 2021, the approach was pretty straightforward. Buy some BTC, buy some ETH, sit on it. The main goal was long-term price appreciation and treating these assets almost like digital gold, basically a hedge against inflation. Just sit on it and that's it. But if you fast forward to today, the game is very different. The whole mindset has shifted from just passively collecting assets and holding on to assets to actively making them generate rewards. And it's happened in a few ways, right? First came active staking, right? Companies started expanding way beyond Bitcoin into assets like Ethereum, mainly because you can stake it. And a great example of this is SharpLink Gaming. They staked nearly all of their 830,000 plus ETH just to earn continuous staking rewards. So it's not just holding anymore, right? It's about turning a treasury into a truly productive asset. And from there, things get even more layered. The more advanced treasuries are now using DeFi strategies like restaking. That's where you basically stake your already staked ETH, basically staking twice, to earn even more rewards on top of your existing stake on other protocols. ETHZilla did this when they deployed $100 million worth of ETH into a liquid staking protocol to really multiply those rewards. And they're also building out strategic buffers. We're seeing this really smart integration of stablecoins into treasuries, and this gives them the cash on hand to manage the inevitable volatility of our space and strategically acquire additional digital assets when the market takes a downturn or whenever opportunity arises. And so you can tell that the game has totally changed, right? Treasuries are acting less like dusty old vaults and more like active dynamic portfolios they should be. So with all this evolution, what are these companies actually trying to achieve? What are the main goals driving this modern approach? Well, it all comes down to about 5 key things. First, growth. They want their treasuries to grow and consistently beat what they would typically get from just holding cash. Next is growing the value of the assets they're holding. They want to generate real value. By staking or lending, they can earn steady fees, steady rewards, and turning that static balance sheet into a dynamic reward generating engine. And then there's ecosystem support. Right, a lot of firms want to strategically support the blockchain ecosystems they operate in, and they see it as a long-term investment that helps their own treasury and the network as a whole, whatever network they support or networks. And 4, there's risk management. Even with all the volatility, the goal is to navigate through it smartly, and they do it through diversification. right? Holding those stablecoin reserves we talked about, and being really careful to avoid too much leverage, too much risk. And finally, there's investor confidence. By being transparent about these innovative strategies, they aim to build confidence and show their investors they're managing their assets responsibly. So those are pretty much the top 5 goals they're looking to accomplish. And that brings us perfectly to wBLT, because it was basically designed by BMX to tackle these exact goals. So if you're new to wBLT, or if you need a refresher, just think of wBLT like the sandwich BLT, as a single token that gives you exposure to a whole basket of different assets. And inside that basket, you have a strategic mix. Half of it, 50%, is in blue chip assets, BTC and ETH, 20% Ethereum, 30% BTC. And the other 50%, the other half, is in USDC. So it's pretty balanced. You get growth potential on one side and the stability on the other. But here's a special part, the real magic behind it. wBLT is designed to automatically earn fees and auto compound them from the entire BMX ecosystem, right? Every swap, every leverage trade, liquidations, NFT mints, all those on-chain activities generate fees, right? wBLT captures a portion of those fees, which means it flows right back into the pool behind wBLT. And this means that wBLT, its balance, is designed to grow over time. No guarantees, of course, without you having to do a single thing. And these fees are also captured from outside the BMX ecosystem as well. Aggregators like Matcha, Swap, OpenOcean, and a couple of others, if they find the best price for their swaps is through BMX liquidity, wBLT will capture a portion of those fees. So it's not set and forget, but it's like set and let it work type of asset, which removes the need for constant micromanagement. wBLT is designed for long-term growth. So where does it come from? Well, first, it's important to remember that this isn't fake growth. It's not from inflationary token emissions. There's no printing of monopoly money here. Every bit of growth comes from real, demonstrable on-chain activity. There are 4 key engines driving that growth. So we'll take a look at each one. First up is trading fees, right? This includes fees from all swaps, leverage trades, liquidations, NFT mints. And the interesting is when perpetual traders on a platform have net losses, those also get added back to the pool behind wBLT. Next is market upside. So the first is more on the active side. The market upside part is more passive. And this is pretty straightforward. Basically, if the underlying assets like ETH or BTC go up in value, wBLT captures that growth as well. Because remember, 50% of wBLT's makeup is a combination of ETH and BTC. And then there's the auto compounding. So all those fees that I mentioned are automatically converted and put right back into the pool behind wBLT, which creates that powerful auto compounding effect. And finally, there's DeFi composability. And as a native base asset, wBLT is like a DeFi building block. Basically means it can be used as collateral paired with liquidity pools on our upcoming DEX, Deli Swap, or even used for some interesting strategies like potential self-repaying loans, since its own value is designed to grow. But of course, no guarantees there. All right, so let's tie this back into those treasury goals we were talking about earlier. When you do that, it becomes really clear like why an asset like wBLT is pretty compelling as an asset to be held in a crypto treasury. When you think about diversification and risk management, right, wBLT offers that built-in exposure to multiple assets and stablecoins. Remember, 50% blue chip assets of BTC ETH, 50% USDC. Which helps smooth out that volatility, right? So the highs are not as high, but the lows are not as low, but you still get exposure to the 2 top crypto assets, BTC and ETH. For growth and additional rewards, it's all about capital efficiency. wBLT is working in multiple ways at once, right? Providing liquidity, capturing market upside, and hedging with stablecoins. And it simplifies operations through hands-off management because that auto-compounding design saves a ton of operational headaches, and it reduces the chance of human error. To really see where it shines, let's quickly compare it to a couple of common options you might see in a treasury. So compared to traditional LP tokens, the huge win here is how wBLT handles something called impermanent loss. Because wBLT is a single token representing a whole basket of assets, big price swings in the market, volatility, can actually become a source of fee generation instead of a penalty. Because remember, wBLT captures fees from swaps, both in its ecosystem and outside the ecosystem through external aggregators. And with increased volatility, you have increased amount in trading activity. Those trades generate fees. wBLT captures a portion of those fees. So again, even in a volatile market, wBLT continues to be a fee capturing engine. So that volatility can actually become a source of fee capture instead of a penalty. And in a perfect world, or by design, wBLT provides a bit of a cushion to impermanent loss, right? We're not talking about elimination of impermanent loss or anything like that. Again, no guarantees here. No guarantees. No guarantees here. And compared to just holding ETH or BTC, wBLT is designed to be a steadier ride, right? Thanks for that 50% stable coin component, it dampens the volatility. And on top of that, it's constantly capturing fees from all that platform activity, both inside and outside the BMX DeFi ecosystem, which can outperform what you'd get from passive staking. Again, no guarantees here.
Because there's no guarantees, you know?
We're talking about design and different scenarios that we could potentially see. When you zoom out, the bigger picture here is the potential for wBLT to become a go-to reserve asset for the entire base ecosystem, right? A single trusted token that captures fees, auto-compounds them, that everyone from treasuries to individual people can rely on. So we've covered a lot of ground, right? We've gone from that simple buy and hold idea to these really sophisticated active treasuries we see today. And the question I want to leave you with is, what could a truly productive, self-growing treasury mean for the future of digital asset management? That's really the idea behind wBLT. It's diversified, it's productive, and it's designed for long-term sustainability, which checks a lot of the boxes companies are looking for strategizing and managing their crypto treasuries.
Nice.
That's it for today. Thank you for joining me on this deep dive into crypto treasuries and how wBLT pretty much checks the boxes or those goals that companies behind these crypto treasuries aim to achieve. Thank you again, and we'll catch you in the next one.